All right, have you ever looked at a stock's price and just wondered, is this thing a total steal or am I about to get ripped off? Well, today, we're going to demystify the one tool that everyone points to for that answer, the PE ratio. We're going to break down what it is, how you can use it, and maybe even more importantly, how it can sometimes point you in the completely wrong direction.
Okay, so let's just jump right in with a question that seems super simple but really trips people up. On the face of it, the answer seems obvious, doesn't it? I mean, the $75 stock costs more money. But, and this is a huge but, in the world of investing, the price tag on a single share can be, well, really deceiving.
So, let's imagine we've got two companies. Sam's Scooter Co. is trading at $75 a share, while Bill's Bike Shop is at $60. Now, your gut reaction is probably, well, Sam's is more expensive, but that's just the sticker price. What we really need to know is what's under the hood. What's the engine driving that price? To figure that out, we've got to dig a little deeper.
See, to really figure out if you're getting a good deal, you need something that connects that share price to how much money the company is actually making. And that's where a really simple little ratio becomes your secret weapon for seeing past that initial price tag. And that brings us to the star of the show, the price-to-earnings ratio, or just PE. It's a beautifully simple but super powerful metric that basically asks one critical question. For every single dollar this company earns, how much am I willing to pay for it? So, a higher PE means you're paying more for each dollar of profit, while a lower one, well, that might just be a bargain.
And you're not going to believe how simple the math is. Seriously, you just take the price of one share and divide it by the company's earnings per share, or what you'll always see called EPS. That's it. And what you get is the single, clean number that lets you compare completely different stocks on a totally level playing field.
Okay, so now let's apply this. Let's see how this simple little calculation completely flips our whole perspective on those two companies we talked about. This, right here, is where you get that aha moment, where the real story behind the price comes out.
So check this out. When we do the math, Bill's Bike Shop has a PE ratio of 20. But Sam's Scooter Company, remember the one with the higher stock price? Its PE is only 15. And just like that, the entire picture gets turned completely upside down.
So what does that actually mean? It means for every dollar of profit the company makes, you're paying only $15 for Sam's stock, but you're paying $20 for Bill's. It's like finding the exact same TV on a shelf, but one is just priced cheaper. Based on PE alone, Sam's is actually the better value. But, and this is a really crucial catch, context is everything. The PE ratio is fantastic for comparing similar companies, like comparing Ford to General Motors. But trying to use it to compare, say, a big, stable bank to a high-flying tech company, that's just apples to oranges. It doesn't work. And why is that? Because investors have totally different expectations for growth, so they're willing to pay wildly different prices for their earnings.
All right, but it gets even a little more nuanced than that. There's another layer to the PE ratio that can really trip you up if you're not careful. It's not just about who you're comparing, it's about when you're looking. Are you looking at the past, or are you looking into the future?
And this is the key difference right here. You have what's called a trailing PE, which looks backward. It uses the earnings a company has already reported over the last 12 months. It's a hard fact, it's in the books. Then you have the forward PE, which is, well, it's a guess. It's an estimate of what analysts expect the company to earn over the next 12 months. Now, it can be super useful, for sure, but you have to remember it is not a guarantee.
Okay, so the PE ratio is clearly a powerful tool. But, and you knew there was a but coming, it is definitely not perfect. In fact, it's got some major blind spots that you absolutely have to know about before you go betting the farm on it.
I mean, think about it. What do you do with a hot new tech company that's pouring every penny it has back into growth so it doesn't have any profits yet? Or what about a solid, established company that's just, having a bad year?
Well, if a company has negative earnings, in other words, it's losing money, then its PE ratio is also going to be negative. And at that point, the metric becomes pretty much meaningless for valuation. It tells you, hey, this company isn't profitable right now, but that's it. It doesn't help you compare it to anything at all.
And you know what? That's just one of its blind spots. Think about this. A high PE might look really expensive, but what if that company is growing its profits like crazy? The basic PE ratio doesn't account for that growth. And maybe even more important, it completely ignores how much debt a company has on its books, which can be a massive red flag. You could have two companies with the exact same PE, but one is debt-free and the other is just drowning in it.
So, to try and fix that whole growth problem, investors came up with something called the PEG ratio. It's basically a clever twist on the P&E that brings the company's expected growth rate right into the calculation. And that really helps level the playing field when you're comparing a slow and steady company to one of those super fast, high-flying growth stocks.
So, after all of this, what's the bottom line? How can you actually use this powerful, but let's be honest, flawed tool in your own analysis without getting burned? Well, here are the golden rules to remember. Number 1, always compare companies in the same industry. Number 2, make sure you know if you're looking at the trailing PE, the past facts, or the forward PE, the future guess. And probably the most important rule of all, never use the PE ratio by itself. Think of it as a fantastic starting point, a great way to begin your research, but it is never, ever the final answer.
Which kind of leaves us with a final thought, right? Is the PE ratio this hopelessly flawed metric that you should just ignore? Or is it the essential first step to finding your next great investment? The real answer, of course, is that it's a little bit of both. The true power of the PE ratio isn't really in the number it gives you. It's in the deeper questions it forces you to ask next.